Every serious real estate investor, from millionaire to billionaire, focuses on three key numbers before buying a piece of property. These three numbers tell you everything: the true value, the potential, and how profitable that property really is. They're cap rate, cash on cash return, and DSCR. And if you understand these three like the back of your hand, you'll be able to look at any deal in any market and instantly know whether it's worth your time. Let's go through each one slowly with examples and context, and by the end, I'll tie all three together with one complete deal breakdown. Let's start with cap rate, short for capitalization rate. Think of this as your property's report card. It shows how much income your property generates compared to its price without worrying about loans or financing. The formula is simple. Cap rate equals net operating income divided by property value. Your NOI is your total income minus your operating expenses. So if your property is bringing in $8,000 a month in rent and your annual expenses from like insurance, property tax, management fees, and even repairs totals $36,000, your NOI is $60,000 per year. If that property costs $1 million, you divide 60,000 by 1 million, which gives you a 6% cap rate. That means the property is generating a 6% return based purely on its income, ignoring the financing. If you come across a property with a high cap rate, say 9% or more, that could mean one of two things. Either the income is really strong compared to the price, or the price is lower than normal because the property needs work. Higher cap rates often mean higher potential return, but also a higher risk. You might be dealing with deferred maintenance, tougher tenants, and the location that requires more management. If you know how to handle that, and if you can renovate and stabilize it, those can be deals that make you real money. Now, a low cap rate like 4 or 5% usually means the property is newer, in a prime area, or already performing well within minimal efforts. These are usually the set and forget it type investments. There's less stress, less work, but there's less return. If you're just getting started and you're hungry to grow portfolio, you might chase slightly higher cap rates because they come with more opportunity. If you're someone who's sitting on a lot of capital and you just want passive stability, then lower cap rates are often the better play. Cap rates give you a quick way to compare properties side by side, almost like comparing stocks based on yield. It's not perfect, but it's a fastest way to spot if something is worth digging deeper into. Now let's move on to cash on cash returns, which is honestly my favorite number. While cap rate shows what the property earns, cash on cash shows what you earn based on actual investment. It answers the question, how hard is my money working for me every single year? The formula is simple for cash on cash return. It equals annual cash flow divided by total cash invested. Let's build on that same property example from before, but this time let's make it a little bit more exciting. So you find a similar 4-unit building for $900,000 instead of $1 million. So that's $8,000 in gross rents, or about $96,000 per year. After paying $36,000 in expenses, your NOI is $60,000, same as before, but now you paid less for the building. $60,000 divided by your $900,000 purchase price gives you a 6.6% cap rate, a little bit better. But now let's look at the financing side. You put 25% down, which is $225,000, and financing the rest $675,000. At a 5.5% interest rate, that gives you a monthly payment of around $3,850, or about $46,200 per year. And if you subtract that from your $60,000 NOI, you're left with about $13,800 in annual profits. Divide your $225,000 investment, and you roughly get a 6.1% cash on cash return. And that is before any rent bumps. Now let's say you want to improve the units a little bit, fresh up the paint, give it updated kitchens and better lighting. You raise the rents by $200 per unit. That brings your total annual rent to $105,600. Subtract the same $36,000 in expenses, and your NOI is now $69,600. After your mortgage, you're left with $23,400 in cash flow. Divide that by your $225,000 invested, and now you're at a 10.4% cash on cash return. That's where deals start to get exciting. You're not just breaking even, you're creating actual monthly income while your tenants are paying down your loan and the property appreciates in value. This number is powerful because it tells you how efficiently your money is working for you. A small rent increase, a better purchase price, or even choosing a smarter loan structure can completely change your cash on cash return. It's not about finding the cheapest property, it's about finding the one where your dollars earn the most. Now let's talk about the last one, DSCR, or debt service coverage ratio. This is what banks use to measure how easily the property's income can cover its loan payments. The formula for DSCR equals net operating income divided by total debt service. Let's plug in our improved property. The NOI is $69,600 and your annual loan payments are $46,200. $69,600 divided by $46,200 equals about 1.5, meaning the property earns 50% more than what is needed to pay the loan. That is strong. Most lenders only require a 1.2 or 1.25 to show that the deal has plenty of breathing room. A DSCR below 1 means the property isn't even generating enough income to pay off the mortgage, and that's a huge red flag. Between 1.0 and 1.2 is tight but doable, and anything above 1.3 is where both investors and bankers feel comfortable. The higher your DSCR, the safer your deal is, and the easier it'll be to get financing. Even if you're not borrowing, DSCR helps you measure how safe your cash flow really is. You always want to have a cushion because it's what keeps you stable through vacancies, maintenance, and market changes. So let's recap using our numbers. You bought for $900,000. After improvements, your cap rate sits around 7.7%. Your cash on cash return jumps above 10%, and your DSCR sits at 1.5. That's a solid performing deal across the board, profitable, financial, and safe. And all it took was finding something slightly undervalued and adding a little bit of sweet equity to boost its income. So final takeaways, cap rate tells you how the property performs on its own, cash on cash return tells you how your cash is performing, and DSCR tells you how safely the property handles its debt. When you understand the relationship between those three, you stop guessing and you start thinking like a real estate investor. So next time you're analyzing a deal, don't just stop at the cap rate, run all three numbers and look for that sweet spot. When all three line up, that's when you know you found something worth fighting for. Thank you so much for watching. I hope you enjoyed and I hope you learned something new to boost your real estate investment career. And if you have any questions, feel free to reach me out on Instagram, steve.vec, and I'll be happy to answer there. Have a good one, guys. Peace.